Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're talking with Erik Wetterling, also known as the Hedgeless Horseman. And we'll put a link to the Hedgeless Horseman down below so you can follow along with Erik's work. And Erik, always great having you on the show. As we kick off this Monday, the 21st, Easter Monday, it's interesting that the gold price is really the only thing up on the screen. Most of the markets are down. It's a sea of red out there. The general equities are down. The dollar is down. You're seeing bonds down. Really, the only other thing beside gold that's up is the VIX, which means more volatility. And so on a day like this, you're seeing a clear safe haven move in the yellow metal. It's a precious metal. Silver is up marginally, but it's really gold that's getting the 3% move. It's added over $100. It's a big move in gold. Especially it's a big move in gold after already seeing months and months of this all through this year and seeing it diverge from the rest of the markets. But what's interesting is the gold stocks, which is the universe that we swim in, are not like universally up. It's not a party hat day where everybody is rallying. You would expect at this kind of a move, if it was in isolation, that the gold stocks would be up double digits today. And the reality is the GDX has been back and forth. When we were talking earlier today, it was actually down. Now it's marginally up. Newmont was down earlier as the biggest gold stock that people look at. Now it's marginally up at the end of the day. And then we saw a lot of producers down on the day, 2%, 4%, 6%, which really doesn't make a lot of sense because their margins are going up. And we saw a lot of development projects whose economics are getting better, $100 better, and who knows what that does to the margins and the economics inside that project. And they were selling off today. So it's very much a mixed bag. What do you take away from a day like this where gold is sailing, but the gold stocks are mixed and everything else is down?
Yeah, I mean, it's just another day in the markets. I mean, can you understand why they are being sold off? It's like, yeah, I mean, we're having bad days in the market, and this isn't really something that I think people get shielded from. I mean, if you see panic and everything pretty much is red, it's like watching every other car burn, but your car is not lit on fire. But how excited are you going to be about your car that's still not on fire? So, I mean, it makes perfect sense from a human psychology perspective, margin call perspective, profit-taking perspective, given that how especially gold miners have done in the recent weeks or months. So it's easy to kind of explain it from market and psychology perspectives. But of course, at face value, if I own a gold mine and gold is 3% higher, $100 higher than gold was yesterday, my mine is making me even more money, so it's worth more to me. That's the thing. It's like, I mean, I probably said this a lot of times. It's like, I don't even try to necessarily make sense of the market at any given time. I think it's good to understand why it's happening. That also means the more you learn about sentiment. It took me years to actually appreciate just how much sentiment alone, psychology, drives the everyday stock prices. I used to think that, you get into the market and thinking it's a well-oiled, high efficiency pricing machine, but it's actually not, because we're seeing that today, for example. And I only find it really interesting from the perspective, it's like if Mr. Market is your opponent, you want to understand why he does what he does and when he does it. Why is that? Not just for interest sake. It's actually how do I take advantage of it, for example. So again, at face value, if a gold mine is making more money today than yesterday, it's worth more on this day than it was yesterday. So it makes no real sense why anything should be more lower price today than yesterday. But still that happens. And as you said, it's been volatile. Some stuff was down. Now it's slightly in the green. So how much did change actually? Did gold price go from red to miners being worthless, even though it is a higher gold price, and then gold is still around the same level? All of a sudden these stocks are green. That doesn't make any sense at all. But that's how markets function.
Do you think, Erik, that it's a function of people pulling profits in one of the few sectors that's in the green this year to deal with other parts of their portfolio, maybe in the general equities that have been crashing? Or do you think it's more that precious metals investors don't believe this gold price is going to stick?
Yeah, I mean, that I can't say. I mean, I'm not an expert on financial markets. I try to keep it simple, just bottom up investing. I would certainly not be surprised. I mean, now more than ever, the marginal investor has a very short time frame, and a lot of people are probably going to be selling what's actually in the green to buy something that's might be in the red. I mean, if you look how does investors typically do? Well, they look at something that has gone exponential, gone up a long time, and they think that's going to continue, so they start buying, and then it goes down more and more. They still want to believe that what has already happened in the past is going to keep going. So I mean, you never know. Maybe people are selling to put into the Mag 7s, for example. And if we're talking juniors, I mean, that's kind of, I would say, much easier to understand because like I've had some discussions today, people, pulling their hair about juniors and especially maybe explorers not going up. They're very far from the production part of the Lassonde curve. So what gold is today and what it is yesterday doesn't really matter that much. Most of them don't have anything worth mining, even at lower or even at this gold price. If they find something worth mining, that might be in production in 15 years. So what you sell an ounce in the gold for in 15 years has no connection to what gold was selling 15 years earlier. It's like you can't save these gold prices and have them here for 15 years. And when I talk to people, it's like I ask them, especially the ones that are whining about the lack of action to the upside in gold juniors. It's like, okay, does this make you more bullish seeing gold go up and the juniors, let's say, sell off? Or are you tempted of buying? And they're like, hell no. So basically, they're much, I would think, closer to selling than actually buying, despite the fact that gold is running away while the gold juniors are staying put. So the funny thing is then that people are complaining that not other people are buying up their shares, given that gold is up. But when you ask them, who are obviously aware of the sector, they're in some of the, or many of these juniors, they are not willing to buy more of it. So I just find it ironic that the people who understand the sector should be able to tell that gold is going up and the prices might be going down. If they're not interested in buying, what makes them think that an outsider who typically chases momentum is going to want to buy the stuff that they're complaining about that they rather want to sell? I mean, at the end of the day, it's momentum that everybody cares about. And right now, despite the gold price, we haven't gotten really that momentum in the broader juniors, and that's why nobody wants to buy them.
Well, speaking of people being hesitant to buy, one of the areas that I'm still surprised by is the M&A space. Yes, we've had a lot of M&A over the last year or so. Of course, we've had about 20, 30 deals. But why are we not seeing 20 deals a month right now at these kind of prices? Because if you're buying a producing asset, the few juniors that have actually bought producing assets have been richly rewarded for that because people can see they're going to have fat margins now instead of diluting shareholders. The few producers that have bought other producers or bought a development project and built it have been rewarded because people can say, hey, that was a smart transaction. You'd planned on lower prices. Now that we have higher prices, fatter margins, why are we not seeing more M&A? I mean, I know we saw one deal today where Lumina Gold is being taken over by the group CMOC. But other than that one transaction, it's been a ghost town the last month or so. Where are all the M&A deals?
Very good question. I can't figure that out myself either. One thing I would think is that they still are kind of gun shy from 2011 going to 2015. I mean, just look at Barrick. They haven't really done any major gold acquisition in some years now, I would say. Basically started to bet on copper and are about to rename the company from Barrick Gold to Barrick Metals. Meanwhile, you have Agnico, who has been active, aggressive. They just surpassed every other gold company, including Barrick, to become the highest valued company. So they're actually reaping the benefits of having invested and been aggressive in the gold space. Of course, they wouldn't necessarily know that the gold price was going to do it like this, but for sure there's cheap stuff out there. But the problem for these super majors are that there's not enough projects out there. If everybody's chasing tier one projects because everybody's like, oh, I got to be prepared for the bad times, which makes sense. It's like, don't get me wrong, but they probably want sub $1,000 per ounce all in sustaining. They want 500,000 ounces of production for at least 10 years or something. How many projects are there out there, especially ones that can be built anytime soon? There's like, the list is so small, so short. It's even, I mean, you see Agnico Eagle, who really only have stuck to North America, Scandinavia, and Australia. just put 100 million into a Colombian gold project, which looks like it could be 10 million ounces. So it's like if Agnico has to go to Colombia to find a big, large-scale gold project, that says something about how few there are. And then, of course, we get to the crux in a sense that these gold companies are so large, the super majors, they can't really do much. I mean, there are no projects really to buy. They have to buy other companies in that case, other producers, and they don't really have many tier one assets. They might have one or something, who knows? So I think actually that the big money, of course, if you find a tier one deposit, that's going to be snapped up really quickly. But hey, I mean, today, right now, as we speak, tier three deposits, tier three mines are having as high margins as tier one mines had like 6 years ago or something. So we've never really seen this before. It's like if you have even not a good gold project, but you get that into production, have it in production today, that's still real money. There's mines out there with 2,000 ASIC. They're still making $1,400 of ASIC margin today. That's higher than the average, I think, major had an ASIC margin in the top of 2011. So it's like tier three projects today are as valuable from a margin perspective, making as much margin as the tier one mines have done for the last, I don't know, 2 decades or something like that. So it's a very weird place, and nobody for some reason really gives a shit about the smaller projects, even though you could put almost anything in. I mean, soon we're going to be able to profitably mine soil samples.
That's a good point, Erik. Well, I think you're making an interesting point about the tier one versus the tier three. And I would submit there's a lot of tier twos in between those that are also profitable. I think people in the industry give a lot of lip service to tier one deposits. Companies say that they're on to a tier one deposit or that they've delineated one. Majors have clearly shown us just the opposite, with Newmont divesting a lot of its non-core projects that other companies would have probably proclaimed as tier one. Clearly they're not, or they wouldn't be divesting them. But if you get a mid-tier company with a tier two or a tier three project, or even a smaller producer that buys a tier three project that's profitable at today's metals prices, it's all transformative for those companies because they have a lot smaller market caps. It takes a lot less to move the needle. And I'm not sure that there's any gold mine on the planet right now that's not profitable at $3,400 gold. So really any mine is profitable. Again, that's why I would expect to see more M&A just for growing the production value, because these margins are so fat. But should investors in general not avoid tier one, because there's still some great deposits out there, but maybe put their focus on some of these tier two and tier three companies and deposits and mines or development projects, because that's where a lot of the M&A deals have been, and that's probably where a lot of the M&A deals will stay, is in the second tier, good mines that maybe produce 100,000, 200,000 ounces of gold a year, but they're not going to produce 500,000 ounces of gold a year. So should people lower their radar a little bit to look for that next rung down on the ladder, because that's probably where a lot of the deals will be?
In a sense, yes, because if you think about it, given where the gold margins are today, if you have a tier three deposit, let's say that's fully permitted, and you could get that up and running within 1 year. I'm just making an example here. It's not a tier one, it's tier three. But maybe even a tier three project today has a payback period of, let's say, 1.5 to 2 years. Maybe a tier two project has a payback of 1 year today. Is that worth something? Obviously, I mean, imagine it's like, okay, if you put the money in and build something, in 1 year, if the gold margins stay around these levels for 12 months, and they might, gold might go higher, you have paid your investment, and then you're free rolling for the rest of the mine life. I mean, how is that not worth something? Do you need a tier one mine? No, I mean, compared to, I'm looking for a tier one deposits, sure, but I bet there's tier three and tier two deposits out there that at these gold prices, I mean, I don't know how much in terms of return on investment you would get, but it would probably be significant, especially if the gold price doesn't fall. So it's like, hey, if you got to go with exploration, I would go for tier ones right now, right? That's the only thing real that makes sense, because birds in the hand, proven success, de-risk projects, semi-permitted projects, even if they're tier three or tier two, whatever it might be, they're obnoxiously profitable at today's gold price and thus today's gold margin. So I mean, hey, I'm getting tempted just buying some crappy 500,000 ounce deposit out there with low capex and getting that into production. Let's say I can borrow some, a few tens of millions, and I'll have 1 year payback. Then I would be free rolling. So personally, what I'm doing is like I'm hiking, let's say, the emphasis on projects closer and closer to the production phase of the Lassonde curve, because they are the ones also that are the closest to actually reaping the benefits of today's superb margins. Because of course gold producers, many of them, they're not like obscenely dirt cheap. It's not like they're trading it up of a P of 2 or 3 or whatever. But imagine then an advanced project that has the junior discount because no institutions can maybe buy it. It's not in production, so people can't easily read the cash flow statement or whatever. But it's like, hey, this could be theoretically in production like 1-2 years. Yes, it's a bet in a sense, and not every junior has the means of actually getting it into production. But there are some, I think, that has good enough projects, has good enough team access to capital or whatever. Because that if you can play, in my opinion, that arbitrage, that would be something. I mean, if you're buying ounces for, I don't know, $100 in the ground, and when in production, let's say that's 1 to 2 years from now, they would have at today's gold price, maybe $2,000 per ounce margin. That's pretty crazy. And again, if you would have to take some dilution, that's probably worth it. And also, if we're talking like debt financing, I mean, nobody has ever gone to a banker to finance a gold mine. And of course, they probably can't use spot gold prices, but it's like, obviously, this sector has never had better fundamentals at spot gold price. So I would think that it wouldn't be impossible to actually finance something yourself. So in my opinion, it's like this is part of actually having to adapt in a sense. It's record margins out there, but yes, early stage exploration stories, they're also dirt cheap. But again, if we look at how actually impactful is it that gold is at $3,400 to an early stage exploration company, if we're honest about it, it's not that relevant because they're not even close to being in production. I would much rather focus my risk reward hunting. I'm not saying that I don't have any early exploration plays, but they tend to be tier ones. But focus it on the ones that suffer the retail discount in a sense, but actually has a shot of those projects actually becoming mines in the not too distant future, at a time when some of these projects again would have like 1.5 years payback, which we've never seen.
Yeah, I think it's going to be fascinating to rework a lot of economic studies at today's spot prices, but see also not just what it does to the net asset value, but what does it do to the payback period? If you can go from 2 years to 1 year, for 1.5 years down to 9 months or something, you literally could get some of these mines built and in the next year pay them off. That's amazing, because it usually takes 2 or 3 years to pay off a mine, and with copper mines even longer. So the fact that some of these gold mines could go up and be paid back so quick, I think is another advantage to either get them developed or buy the ones that are near development or buy the ones that are already producing. But there's also these projects that have been sitting on the vine forever. And I just got to ask you this question. We talked about it off mic, but when you think about companies like Nova Gold, 39 million ounces of gold. International Tower Hill, I think they've got like 14 million measured and indicated. When you think about something like Artemis Gold's Blackwater project, about 12 million ounces of gold. We talked about Perpetua. They got about 6 million ounces of gold plus the antimony kicker. Troilus Gold has 11 million ounces of gold. There's all these companies that have insane amounts of gold here. Why are they not getting scooped up by the big boys? Why are larger companies not saying, hey, now's the time to finally build International Tower Hill's Living Good mine, or now's finally the time to build Nova Gold's project? Why are, at these prices, companies not acting on their massive projects that finally are incredibly economic?
I mean, I do think it goes back to them being gun shy and almost in a bit of a shock, because honestly, it's like I barely got accustomed to seeing gold at $2,200 before it was already at $3,000. And obviously, if we look at presentations, I mean, some juniors have presentations from January, even if they're a developer. So the difference in gold price between January and today, I don't know how much that is, but several $100, I would think. So it just changed so very quickly. And I think everybody kind of doesn't believe this gold move. And we've seen reports of, Wall Street saying that gold is one of the most crowded trades right now, even though I don't buy that, especially not for Western investors. But anyway, so I think everybody's in a state of disbelief. And I think that's also what's getting people even more paranoid. And then they look at the, lack of share price movement. Then that feeds into that paranoia, thinking that, oh, the junior sector for the first time ever actually knows something that nobody else knows. So I think that's a self-fulfilling prophecy. And I don't know the specifics of all the, all those projects, the economics, but I wouldn't be surprised if you have some of these large-scale projects that's like, if you use spot gold price and you bought the projects at 50% premium, I wouldn't be too surprised that they would also have even the quote optionality place, that they would have like sub 2-year payback or something like that. Then the problem, of course, is that, well, how close are they to development? Because let's face it, if you have a deposit absolutely ready to go and you could build it in 1.5 years, gold will probably not have had enough time to fall that much, even if you're in a bear market. But if you're buying something that's, well, this might be still 5 to 6 years out, then you're somewhat taking a gamble at least. But some of these large projects also have pretty robust ASIC estimations. I mean, it's a guesstimate, of course, but if you have 900 ASIC or 1100, I mean, you're probably not going to end up losing money on it anytime soon. I mean, even if gold corrects in a big bear market, it usually doesn't go down more than 50%. And if that happens, I would think we're not in inflation, rather in deflation. So, I mean, then you would actually at least survive the low part of the next cycle. And gold could go to $6,000. So you'd make a shit ton of money. It's like, I would think that some of these majors would be starting to make bets, because even if they buy one of these large projects today, I mean, they're probably making more in free cash flow every year. And even if gold drops a bit. So I see it as not even high risk, like medium risk, high reward type scenarios for these majors. But who knows, maybe, CMOC will kick this off from buying. Well, we've said this a few times already, but it's like someday these majors got to start acting, because like personally, if I ran a gold mining company, I wouldn't want to be a super major because the investment space is so small. I would want to be probably a mid-tier and just start to buy every decent, very advanced project out there that I could actually finance myself. Because again, like we said, if you're looking at 1 to 1.5 year paybacks, I mean, how much risk are you taking? I wouldn't say much. And of course, the upside would be absolutely huge if gold prices hang in here for even 5 years. You made your money back in first year and a half, double your money for 2-3 years after that, and let's say you still make money on it, and the mine goes on for who knows, it's a low gold deposit, so you're buying whatever it looks like today, and it's gonna end up having like 2-3 times the ounces you're actually buying. So I mean, it's just, in my opinion, absurd. I wish I ran a gold miner right now.
Well, I think we'll wrap it up there for today, Eric, but just putting the feelers out there to the listening audience. If anybody has a mid-tier gold company they need somebody to run, Eric's volunteering. It's a good time to be a gold producer. I do think it's a great point you made, though. This is the time to press the go button, because a lot of these projects on economics on paper still make sense at $1,600 gold, $1,800 gold, $2,000 gold. So even if you took a year to build a project, year or two, by the time you get it into production, you're still going to be at a much higher gold price. It won't have the time to fall all the way back to 1,600 or 1,800 by then. So you could make money, pay the project back, and then have optionality on the next decade or two at that mine. So hopefully we see more mines built, more mines bought, more development projects bought, more M&A in the cycle. But what we can say is we're at record high gold prices again to kick off this week. And it's not every boat rising with the tide. So we're not at a mania stage yet. And I would agree with the point you made. We're not really in an overcrowded trade, because most people don't even own any gold, and they don't own any gold miners. So it's hard to be in an overcrowded trade when nobody owns it. So we'll keep following along with the wild and volatile general markets and the precious metal sector. And if people want to get more thoughts from Erik, definitely click on the link in the show notes. It takes you over to thehedgelesshorseman.com, where you can follow along with the companies on his radar, some of the press releases that he follows, but also some of the videos he makes where he weighs in on different trading techniques in the resource space. And Erik, great to have you on the show. As always, looking forward to our next conversation.
Thanks, Chad, the same. And I would just like to end with one caveat, again, just pointing to the importance of a project that can get built, permitted, and is good enough. Because if you have a big project that really can't get permitted, doesn't matter. It's never going to be really close to that point in the Lassonde curve. So it's like I would really put an emphasis on projects that legitimately can become gold mines in the not too distant future, because otherwise it doesn't, again, matter at all what gold is right now or going to be in the future.